Let me be brutally direct with you right now, because nobody else in your life has the guts to say this to your face. The most sophisticated financial institutions on the planet, the entities that literally print money, that control interest rates, that move the levers of the entire global economy, those institutions are quietly, deliberately, and urgently moving their reserves into gold. Not stocks, not bonds, not the dollar, gold. And while they are doing that with military-grade discipline and a 5-year strategic horizon, you are sitting at home watching your savings account earn 4% interest and congratulating yourself like you just won a championship. You have not won anything. You are losing a slow, invisible war against inflation, currency debasement, and geopolitical chaos. Central banks know this. They have always known this. The only question that matters today is whether you are finally going to listen or whether you are going to keep losing. If the information in this video is new to you, then you are already behind. Every single week on this channel, I break down exactly what the smartest, wealthiest, and most powerful financial minds in the world are doing with their money. And I explain it in language that you can actually use. That analysis, if you paid a private wealth advisor for it, would cost you thousands of dollars per year. You can get it here for absolutely nothing, but only if you subscribe right now. Hit that button, turn on notifications. Do not watch another second of this video until you have done that, because the people who subscribe are the people who stay informed, and the people who stay informed are the people who build wealth. Now let me introduce you to a man named Joe Cavatoni. He is the senior market strategist at the World Gold Council, and his literal professional function, the thing he gets paid to do every single day, is to survey central banks around the world and understand their thinking on gold. This is not a retail investor with an opinion. This is not a financial influencer with a course to sell. This is the man with a direct line into the institutional thinking of the most powerful reserve managers on earth. And what he is telling us right now should completely reframe how you think about your own portfolio. The core message is devastatingly simple. Central banks are buying gold. They are buying it consistently. They have been buying it for years, and they have absolutely no intention of stopping. Now, why does that matter to you sitting wherever you are right now, probably not managing a sovereign wealth fund? It matters because central banks are not emotional. They are not reactive. They are not chasing momentum or watching YouTube videos for stock tips. They operate on 5-year strategic horizons with teams of PhD economists and geopolitical analysts advising every single allocation decision. When institutions like these move this consistently and this deliberately into a single asset class, that is not noise. That is a signal. And the signal they are sending right now is one of the clearest and most important signals in modern financial history. Here is the foundational fact that you need to burn into your brain before we go any further. Gold is recognized by the International Monetary Fund and other global governing bodies as a reserve asset. Silver is not, let me say that again so it lands properly. Silver is not a reserve asset in the eyes of the institutions that govern global finance. So if you've been waiting for some kind of central bank silver buying wave to validate your silver thesis, you can stop waiting. That is not the trade we are talking about today. What we are talking about is gold. And the institutional tailwind behind gold is not a theory. It is a multi-year, mathematically documented trend of accumulation by the entities that understand money better than anyone else alive. That is the battlefield. And right now, central banks are winning on that battlefield while the average retail investor is not even aware a battle is happening. So why are they buying? What specific threats and concerns are driving the most sophisticated financial minds in the world to accumulate gold at this scale and at this pace? Because here's the thing. The reasons central banks are buying gold are not exotic or complicated. They're not based on some arcane macroeconomic model that only a PhD can understand. They are, in fact, the exact same concerns that you should have about your own financial life, just operating at a nation-state level instead of a household level. The first concern is inflation. Every central bank in the world right now is dealing with what Joe Cavatoni calls homegrown inflationary concerns. These are not abstract numbers on a government report. These are the real grinding, compounding effects of currencies that have been printed in quantities that would have been considered insane 20 years ago. When a central bank looks at the purchasing power of its own fiat currency over a 10-year window and sees consistent structural erosion, it does not sit on that currency. It moves into an asset that preserves purchasing power across centuries. That asset is gold. Now ask yourself this honest question. What has the purchasing power of the dollar done over the last 10 years? What about the last 20? The math is not complicated. $1 in 2004 buys roughly 50 cents worth of goods today. That is not an opinion. That is arithmetic. Central banks understand this arithmetic at a sovereign level. The question is whether you understand it at a personal level. The second concern is geopolitical risk. Central banks are not naive about what other governments are capable of doing. After watching Russia have hundreds of billions of dollars in foreign reserves frozen almost overnight in 2022, every single central bank in the world that was holding large quantities of dollar-denominated assets woke up to a reality they could no longer ignore. Your reserves are only as safe as your relationship with the country whose currency those reserves are held in. Gold does not have that problem. Gold is nobody's liability. Gold cannot be frozen by a hostile government with a keystroke. Gold does not depend on a swift transfer or a correspondent banking relationship or a geopolitical alliance that could collapse next Tuesday. It sits in a vault, and it is yours, unconditionally and permanently. Central banks understand this at the geopolitical level, but think about what this means for you at the personal level. You might not be worried about your country's foreign reserves being frozen, but are you worried about government overreach into your personal financial life? Because that concern is not paranoid, it is rational. Governments surveil bank accounts, they monitor credit card transactions, they track digital payment platforms, and they can, with very little warning, decide that something you were doing legally yesterday is a problem today. Gold is outside that system. Gold is outside government control in a way that your bank account, your brokerage account, and your digital wallet simply are not. Central banks are buying gold because they do not trust the system that they themselves created. That should tell you something important about how much you should trust it. The third concern is the most historically significant of all: de-dollarization. Over the next 5 years, according to Joe Cavatoni's surveys of central banks globally, these institutions are signaling a deliberate, planned reduction in their dependency on fiat currencies, and specifically on the dollar and the euro. Not on the Zimbabwean dollar, not on some emerging market currency that nobody trusts anyway. On the dollar, on the euro, the two strongest, most liquid, most globally accepted fiat currencies in human history, and the institutions that print those currencies, or that hold those currencies as their primary reserves, are now telling the world, we want less of this and more gold. If that does not stop you cold in your tracks, then you are not paying attention. Because if the people who run the global monetary system do not trust the global monetary system, what exactly are you trusting when you hold cash? Now let me talk about price, because this is where a lot of people get confused and a lot of people make catastrophically expensive mistakes. Gold recently went on a run. We are talking about a 30% increase in a relatively compressed period of time, and then it corrected. And when it corrected, the retail investor community had one of two reactions. Some people panicked and sold. Others looked at that correction and said, this is exactly what I was waiting for. The difference between those two groups of people is not intelligence, it is time horizon. Joe Cavatoni was not surprised by the correction. What surprised him, what he specifically said, was unexpected, and unrealistic was the 30% run-up that preceded it. Think about what that means. The man who surveys central banks for a living, the man with the deepest institutional knowledge of gold demand dynamics on the planet, looked at a 30% increase in the gold price and said that was too fast. That was speculation. That was momentum trading and leveraged products and accumulator instruments in Asian markets all piling in at once, creating a price spike that was not justified by the fundamental demand picture. And then when the music stopped, the price corrected, and everyone who had chased the momentum on the way up suddenly found themselves holding losses and wondering what went wrong. Here's what went wrong. They were thinking in days when they should have been thinking in years. Joe Cavatoni's framework for gold is not a trading framework. It is an accumulation framework. And the fundamental difference between a trader and an accumulator is this. A trader looks at a price dip and asks, is this the bottom? Should I sell before it goes lower? An accumulator looks at a price dip and asks, how much can I buy? Central banks are accumulators. They are not checking the gold price every morning and making decisions based on what the chart looks like. They are executing a multi-year strategic plan to increase their gold holdings as a percentage of their total reserves, and temporary price dislocations are not a threat to that plan. They are an opportunity within that plan. The lesson here is absolutely critical, and I want you to hear it clearly. If your investment thesis for gold is fundamentally sound, and based on everything we have discussed so far, the case is very sound, then a 20% correction is not a signal to exit. It is a signal to accumulate. It is the market offering you a discount on an asset that the smartest institutional buyers in the world are trying to own more of. The central banks of the world are not selling into that correction. They're buying. And if your time horizon is measured in years rather than days, you should be doing exactly the same thing. What Joe Cavatoni is forecasting for gold going forward is not a dramatic vertical spike. It is a slow, steady, structurally supported bull market driven by consistent institutional demand and a deteriorating global faith in fiat currency. That kind of bull market does not make headlines every morning. It does not give you dramatic moments where you feel like a genius, but it builds real, durable wealth over time, which is precisely what most retail investors claim they want, and then consistently fail to actually pursue because they lack the patience and the discipline to stay the course. Now, I am going to do something that most gold advocates refuse to do because they are either intellectually dishonest or they are too afraid of undermining their own argument. I'm going to give you the genuine bear case for gold, steelman it properly, and then explain to you exactly why, even after taking it seriously, the bull case still wins. Joe Cavatoni himself laid out the primary headwind for gold, and it centers on a specific crisis scenario. Here's how it works. If the global economy enters a severe enough crisis, if we are talking about oil at $120 a barrel, sustained over a long period, if we are talking about a genuine liquidity emergency at the sovereign level, central banks may be forced to sell gold in order to fund their obligations. Gold is, among its many properties, one of the most liquid assets on the planet. It can be converted to cash quickly and reliably in a way that most other reserve assets cannot. And so in a worst-case scenario, the very institutions that have been buying gold could become forced sellers of gold, and that selling pressure could create a significant and sustained price decline. That is a real risk. It is not hypothetical. It is grounded in how central bank reserve management actually works under stress conditions. So now let me tell you why that bear case, as serious as it is, actually reinforces the long-term bull case rather than undermining it. First, the scenario that Joe is describing is not a normal recession. He is not talking about a slow quarter of GDP growth or a manageable spike in inflation. He is describing a global financial crisis of a magnitude that would make 2008 look like a minor correction. We are talking about a world where the dollar and the euro are no longer accepted as payment, where multiple large sovereign economies are simultaneously unable to fund their obligations through normal debt markets, and where the only liquid instrument available to meet those obligations is physical gold. If that scenario occurs, yes, you will see gold selling from central banks. You will also see a level of economic and social chaos that makes the price of gold almost secondary to your immediate survival concerns. Joe Cavatoni himself called it, if that scenario materializes and you are in a position to weather the chaos, if your basic needs are covered, if you have food, shelter, and security, then that moment of central bank gold selling is the buying opportunity of a lifetime. Second, and far more importantly, the preconditions for that bear case are the same conditions that made gold valuable in the first place. A world where fiat currencies collapse, where sovereign nations cannot fund themselves, where the entire global financial architecture is under existential stress. That is not a world where you want to be holding paper assets. That is precisely the world where physical gold held outside the financial system is the most valuable thing you can own. So the bear case for gold is essentially gold might get cheaper right before the entire global financial system collapses. That is not a reason to avoid gold. That is a reason to own more of it and to make sure you own it in physical form, not as a paper derivative. I have now given you the institutional case, the macroeconomic case, the geopolitical case, and the bear case for gold. Every single one of those cases points in the same direction. So why are the majority of retail investors in the Western world not buying gold? Why, when you look at the data, do you find that the average American has less than 1% of their investable assets in gold, while central banks are actively trying to increase their gold allocations to historic highs? Is it because those retail investors have done the math and concluded gold is a bad investment? No, because when you actually do the math, gold has outperformed the S&P 500 over the last 25 years. That is not an opinion. That is documented historical performance. So if it is not the math, what is it? Joe Cavatoni and the host of the interview he gave started circling the answer brand narrative, institutional bias, conflicting incentives from financial advisors who make commissions on products other than gold. All of those are real factors, but the most honest and the most powerful explanation is one they did not fully articulate, and it is this: tribe. Human beings are tribal animals. We have been since the beginning of our existence as a species, And that tribal instinct is hardwired into our psychology at a level that no amount of logical argumentation can easily override. You belong to tribes. You have a family tribe, a friend tribe, a professional tribe, a political tribe, and a social tribe. And each of those tribes has cultural norms, unspoken rules about what is acceptable, what is smart, what is ridiculous, and what marks you as an outsider. In certain tribes, and this is more common than you think in upper middle class professional circles in the West, gold is for conspiracy theorists. Gold is for people who wear tinfoil hats. Gold is the punchline at the golf club. Gold is what your weird uncle in the country talks about while everyone else rolls their eyes. And so even if you sit down alone late at night and you run the numbers on gold, and the numbers make undeniable sense, even if a part of your rational mind says this is a real asset with a 25-year track record about performance, you are not going to bring that up at dinner with your colleagues. You are not going to tell your spouse's family that you've been buying gold. You are not going to risk the social consequences of being that person in your tribe, because the cost of tribe membership is conformity and the benefit of tribe membership is belonging. And belonging is one of the deepest human needs that exists. This is not a criticism. I want to be clear about that. This is an observation about human nature that even the smartest and most financially sophisticated people in the world are subject to. The reason I am telling you this is because awareness is the first step to freedom from it. If you can identify the mechanism by which your tribe is preventing you from making a rational financial decision, you can at least make a conscious choice. You can decide, is the opinion of my golf buddies about my investment portfolio actually worth more to me than my own financial future? Is the social comfort of laughing at gold in a room full of people who own only stocks and bonds actually worth the cost of the purchasing power I am losing every year to inflation? Because make no mistake, there is a cost. The people who avoided gold because of social risk and spent the last 25 years with zero gold allocation in their portfolios paid a measurable, quantifiable price for that social comfort. The math does not forgive tribal loyalty. It just keeps running. Here's where I leave you, and I am not going to be gentle about it. You have just watched central banks, the most sophisticated, best resourced, and most informed financial institutions on the planet, tell you through their actions and through the public statements of their representatives exactly what they think about fiat currency and exactly what they are doing to protect their reserves. They are buying gold. They are buying it consistently. They are planning to buy more of it over the next 5 years. They are reducing their exposure to the dollar and the euro because they do not trust fiat currency even at the sovereign level. That is the reality. Now you have a binary choice in front of you. You can take that information seriously, do your own research, evaluate your own portfolio allocation, and make a deliberate, rational decision about whether gold belongs in your financial strategy, or you can go back to your tribe, laugh about the tinfoil hat crowd, keep 100% of your net worth in assets that the people who print money no longer trust, and find out in 10 years what that decision cost you. I cannot make this decision for you. I can only give you the information, give you the framework, and give you the truth. And what you do with it is entirely your responsibility. But understand this absolutely clearly. Ignorance at this point is a choice. The central banks have told you what they are doing. Joe Cavatoni has told you why, and I've told you what it means. The only remaining question is whether you are going to act like an investor or keep acting like a bystander while the most powerful financial institutions in the world position themselves for what is coming. Subscribe, share this video with someone who needs to hear it, and start doing the math on your own portfolio today, because the math does not wait for you to feel ready.